Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. It's coming down hard here in Mumbai in terms of the downpour. Still not morning because it's kind of dark out there. That's the kind of weather, and maybe true for the market from overnight as well, which we will discuss in great detail. We're coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. So dark clouds on the market as well, right? And it was pretty gloomy as you stepped out of your home this morning. Hopefully, that won't rub off on the markets, but looks like it's going to be a tough day.
Well, it's going to be an action-packed day, and the bulls have their hands full. So let's get straight to the action, Prashant.
Oh, absolutely. And I just hope it's passing clouds, right? Not
Doesn't look like
for the
actually.
next 10 days. But it's a bit of a pullback, and I think, there's no other way to sort of put it. It's an ugly, ugly session from Wall Street. So you have basically the S&P 500, which was down about 2.5%. The Nasdaq was down 3.6%. The CBOE Wix jumped 22.5%. Just sort of take those numbers in because they are large cuts. When is the last time you had? I mean, actually, I don't think we've had a 2% plus cut on the S&P for the last 300 plus days. And of course, Nasdaq down almost, it's closer to 4 than it is to 3, right? So those are large cuts. And the jump in Wix as well. Now, it's earnings which have disappointed. It's not the macro indicators, macro markets which have moved. If you're wondering if yields have gone crazy or dollar has seen a knee-jerk sell-off or nothing. It's earnings. Tesla, of course, we had the numbers because the numbers came out the previous session after hours. And the stock reacted in a significant way. It was down about 12%. Ford came out with earnings. I mean, that's an indicator of sort of the manufacturing, real economy, health of the consumer, etc. That was down about 11%. You also had NVIDIA, which was down 7%. And it's not as if NVIDIA reported numbers. Google reported numbers. And essentially, there was disappointment. I'll tell you why. Because Google said that they spent $13 billion in the quarter they reported for in terms of CAPEX. And they said next quarter also we'll spend $13 billion. So there was no growth in CAPEX from Google. And what does Google spend on? A large portion of it would be servers, etc. That's where NVIDIA's chips would go into. And that is the reason why NVIDIA sold off 7%. Actually, the sell-off, in these AI semiconductor stocks like NVIDIA, Taiwan Semi, and others, etc., started middle of last week when some of those reported numbers, and it's kind of picked up pace with Google reporting numbers. Google numbers, mind you, by themselves were pretty solid. The search business has done very well. YouTube, maybe it's a bit of a miss. It's got implications for listed stocks here in India as well, which we can come to a little later. But, you'll need confirmation, right? Is this like a one-off thing or is this a trend? So we'll have Microsoft, Meta, and Amazon all reporting numbers next week. So those are the other sort of magnificent 7 companies which will report. In terms of data, in economic data, there is the second quarter GDP numbers and jobless claims later this week, today and then on Friday. Core PCE on Friday. I think it's a closely watched inflation gauge by the Fed. So sort of putting all of this back and looking at the Nifty here. Yesterday was a session where the Nifty was flat. Broader markets rallied hard. Small cap index was up 2%. Mid cap index was up 1%. Nifty did nothing. But the Nifty did defend the 20-day moving average at 24,346. And it defended it successfully. I think that comes under a bit of a test once again. Remember, the Nifty Bank and the mid-cap and the small-cap indices had all broken the 20-day average while the Nifty had defended it. On the downside, watch the panic low on the day of the budget, which was made immediately after those announcements, which is 24,074. And if that goes, 40-day exponential comes into play, which is 23,860 odd levels for the Nifty. Coming to the Nifty Bank, we closed below, we broke below the 40-day exponential, which is 51,292, but we ended marginally above that, right? So that is, again, the key level to watch out for. And on the upside, I'm not putting out upside levels because you basically need a break above the recent highs for continuation, which is not the case today. I just want to end with this one point. If you look at the F&O positioning, FIIs were super long and HNIs were super short. Both have moderated their positions quite a bit. FIIs have cut longs dramatically. The long positions are about 2.4 lakh contracts. It was about 3.9. And clients have cut short positions. It's now only at about 55,000 contracts as of yesterday's close. GIFT Nifty will come up on your screen. The global handoff is pronouncedly negative, and there isn't very much by news flow in terms of the budget or earnings for that matter. And it's not so much the budget, but look at the earnings momentum, which has been slowing down. very few surprises on the upside and more disappointments, I think, which doesn't help at the margin. So 200-point lower, I think those levels that I mentioned will be important, especially the budget day panic low. I mean, I think that must stay if we are to go into a slightly sideways kind of a price action. Otherwise, you're looking at slightly lower levels from here. Sonia.
Absolutely. And, I think that perhaps the budget day hangover is not up just yet, right? Now people are waking up to the fact that they have to pay a lot more taxes, whether it is long-term capital gains on equities, whether it is on real estate. So I guess that ramification also is something that could play out in the market over the next couple of days. But I take your point entirely. Today, the main reason for the weakness could be what's happening across the globe. It was a 500-point slide that the market saw, the Dow saw rather, and the Nasdaq has seen its worst day since 2022. The Nifty so far has been holding on to 24,400, but we are expecting some sort of pressure today. Foreign investors actually sold big time and sold for the second straight day. So I think put together in about 2 days, it's almost 8,000 crores of selling that we've seen from FIIs. And this is peculiar given that we've seen so much buying up until now. So maybe time to sit up and be a bit cautious. A lot of stocks in focus today. Some of the big numbers that will come out include Tech Mahindra, Ashok Leyland, DLF will be reporting their numbers. So keep that on your radar. And in terms of result reactions, Axis Bank would be on the downside because we did see operational weakness come in for Axis Bank this time around. And L&T numbers were decent. Execution was a bit of an issue, but 15% revenue growth, profits up almost about 12%. No negative surprises in the numbers, but nothing great either. So, just keep an eye out on some of these names. But Nigel, over to you. What are you tracking?
Well, the bulls are facing the headwinds this morning. The question is, can they fight back? Because that's the big question, going by the kind of downtick that we're likely to see on the GIFT Nifty, what the GIFT Nifty is indicating. And today we have the monthly expiry as well, both on the Nifty as well as the Nifty Bank. The headwinds are the global markets are weak, earnings, nothing really to write home about, and the FI selling, that's intensifying. For the time being, you have the DIs which are combating that, and their participation has been higher than the FIs. So they've been absorbing a lot of that selling. What about the FIs and index futures? Well, they unbound some long positions, but they added shorts. If you're asking for shorts in the system, well, you've got it. Close to around 40,000 contracts is what they've added. And now the short positioning has moved up from around that 15% earlier in the series to around 31%. And the chart will tell you the picture. The FIs, they've cut their longs. They were closer to around 4 lakh contracts odd. It's come down to around 2.4 lakh contracts odd. I personally like to see some shorts in the system because it gives you some reason to see a bit of a short covering bounce. So that's one data point. The other one is the client positioning. It was close to 3 lakh contracts at the start of this series, and now that's come down to only around 55,000 contracts odd. So the clients covering the short positions, the FIs lightening the long positions as well. It's an interesting positioning getting into the next series. But for today, let's look at the options data. You had a couple of strikes that were very active. 24,400 call, 24,400 put, very, very active. If there's a strategy going on out there, then it's a short straddle. That's you write the, both these two strikes and you pocket the premium, which on an average is around 200 rupees. Which means that those writers, they are hoping that the 24,200 level is protected in today's trading session. That's going to be the important mark because we're likely to start off very, very close to that mark. Let's get to the levels then that we're looking at. The support level, very important where we're going to be starting off. And that's why I'm saying that that's the important level going by the options data. You have the lows that we saw earlier this week. That's the other reference point. And the 20-day MA, that gets breached. At some point of time, the bulls will want to fight back and get it closer to around the 20-day MA. So that's important. The problem pocket has been the Nifty Bank because that's making lower lows on a day-to-day basis. And just take a look at it. In the last few sessions, it's been making lower lows. That's a problem pocket. But for the Nifty Bank, 50,500, 50,600, extremely important. And a few reasons come up for you on the screen. That means that's a 5% correction from the recent peak. So that's why this level is important. The recent low is around, that mark. And also the 50-day MA in this vicinity. So this is crucial that the Nifty Bank defends this mark. Yesterday, it bounced off 500 points, this level. So keep an eye out on that one.
Okay, so looks like it's going to be a very tough day today. Don't forget that we have, not just a lot of big numbers, but a lot of result reactions as well. And not looking great on that front. So let's get you some opinion on how to approach the markets now. Jonathan Garner of Morgan Stanley says that in Asia, they book profits on their long-standing IT, overweight, they move to equal weight on elevated relative performance, valuations and crowded ownership. He notes that the change in Asia market leadership historically occurs ahead of the first Fed cut. He upgrades consumer staples ex-China to overweight for defensive domestic oriented growth.
Okay, some money market views here. This is Parul Mithil Sinha of Standard Chartered Bank, who says the rupee has been range bound in a narrow band between 83.65 to 83.73 to the dollar as it continued its gradual depreciation amid higher demand from oil importers and a stable dollar. She says the rupee could continue its gradual depreciation if we see FPI outflows in the period ahead. She expects the dollar INR to trade in a range of between 83.5 to 84 to the dollar in the near term.
And on the bonds, Parul says the budget surprised the markets by targeting a fiscal deficit at 4.9% of GDP, narrower than the 5.1% in the interim budget. She says the dated borrowing was reduced by 0.12 trillion rupees and T-bills were lowered by 1 trillion rupees respectively, and this led to short-end Indian government bond yields moving lower, while the long end remained flat. She says better than expected fiscal consolidation target led to good receiving interest in overnight index swaps. She expects the 10-year benchmark bond yield to trade in a range of 6.93 to 7% in the near term.
Okay, all right. We'll take a quick commercial break here, but we'll come back with William Buter, independent economic commentator. Needs no introduction. He's, of course, now with Mavricon LLC. So someone who's watched global markets a long, long time. Stay tuned. That's coming up. Okay, we have, as promised, William H. Buter, independent economic commentator at Mavricon LLC. William, of course, has spent a long time, a lifetime at Citi earlier. William, it's great to have you with us here. Thank you very much for your time. Prashant this side. We had a bit of a pullback, but as I was saying, doesn't look like this was some of the macro markers which were the drivers. This was just earnings. Earnings disappointment more than anything else. Tesla, Ford, Nvidia, I mean, Google numbers were good, but what others read from the numbers perhaps was that capex bit. Just your thoughts on the pronounced sell-off we've seen overnight. Nasdaq almost down 4%.
Yes, it's clearly a significant correction, but it was most severe among companies that disappointed specifically, like Nvidia and the Tesla electric vehicle-related enterprises. So this is not, I think, yet part of an overall correction of a price-earnings ratio that, in my view, is unrealistically high, even after today's minor correction. We've seen unprecedented increases in stock prices in all the US markets and many European and global markets as well, which can only be rationalized if one extrapolates earnings growth in a very optimistic manner. And I think that with the likely geopolitical tensions that are going to emerge, regardless of whether Trump gets re-elected or not, these tensions will be there. We're going to see, in all likelihood, a slowdown of underlying global growth potential. And still some unrealistic optimism in global stock markets.
William, hi, good morning, and thanks a lot for joining in. You have tracked several economies for a very long time, so I wanted your understanding of how you would approach the Indian economy now, given that we've just had a union budget, and from a consumer or from a retail investor standpoint, taxes have gone up across all asset classes. Do you think that would hinder growth, performance? How do you sort of read into that for the medium to longer term in a market like India?
Well, the short-term cyclical effect of this fiscal tightening may be slightly negative for economic activity and stock price, other asset prices. But the clear evidence that the Indian government is taking fiscal sustainability seriously and will not let its public debt get out of control has to be good news for the stock markets in anything except the short run. So I do not see this sort of fiscal innovation as medium and longer term negative for Indian stock prices. I see it as rather as a positive. We don't see any evidence of fiscal corrections on the way in the US, in Europe, in the UK, in Japan, but in India, the authorities seem to have woken up to the challenge that the budget poses for them. And that's to be commended.
Okay, all right, that's heartening to hear then. India's on a strong path and appears quite positive about it as well. But Mr. Boyter, let me ask you about China. That seems to have been trying to get its act together, but it's failing. And that's impacting commodity prices as well. How do you see that economy shaping up? And what about the market out there? A big, big underperformer.
I see the medium and longer term economic prospect of China as quite worse than what we've gotten used to in the past. If the current Xi Jinping policies for restoring some form of state-owned state capitalism with major reliance on investment rather than on the consumers, and diversion for international trade. If that continues to take hold, I see prospect in China structurally as poor. Of course, there's still the enormous mess of the housing bubble and the associated debt crisis, which has still not been addressed comprehensively. So,
William, we'll leave it there. It's a pleasure having you with us here. Sharp comments there. Appreciate your time here on CNBC-TV18. That's William Buter, economic commentator at Mavicon. We'll take a quick commercial break here. We'll come, of course, keep talking about what's happening in global markets. We'll have the gift nifty coming up for you as well. But on the other side, it's all about stocks. Our research team joins in to run you through the stocks that you need to have on your radar, earnings and otherwise. Stay tuned.
Well, today looks like it's not going to be a good day at all. The gift nifty is suggesting a steep fall. Global markets are under pressure. Our own markets are still reeling post the budget, and there's been large selling from FIs for the second straight day. Added to all of that, earnings have not been that impressive. Let's get our entire research team to tell us more about that. Abhishek is joining in first up to tell us about Axis Bank. Abhishek, over to you.
Well, Sonia, it was operationally a weak quarter, as well as the fact that stress have increased for Axis Bank. So deposits are up 12.8% YOY, and they have declined by 0.6% sequentially. YOY, it's the weakest growth that you are seeing in last 6 quarters, and sequentially, it's the weakest growth that you are seeing in last 4 quarters. Advances growth was 14.2% YOY and about 1.6% sequentially. YOY, it's the weakest growth in last 8 quarters, and sequentially as well, it's the weakest growth that you are seeing in last 8 quarters. Slippages have increased to 4,793 crore versus 3,471 crore in the previous quarter. Analysts were pegging a slippage of 4,000 to 4,500 crore, and this is on the higher side. So the annualized slippage ratio is at 6-quarter high, while the annualized credit cost is at 12-quarter high of 1%. Management has guided that credit cost will increase going ahead. With reference to the P&L, both the ANA and PAT is ahead of our poll. Back to you.
Okay, thanks for that, Abhishek. Well, let's hop across to Vivek, who's here to tell us about Big Boy L&T. Vivek?
Well, good morning. L&T, no negative surprises. That's the good part. Q1, when you're looking at the domestic part of the business, execution was hampered by election, the heat wave, and also labor shortages. And also the domestic order group book grew just around 1%, slightly better than analyst expectations, who were actually anticipating a decline. Now, talking about the international order book as well as execution, both quite strong over there. Now, talking about the numbers itself, revenues higher by almost, revenues coming in higher than the CNBC-TV18 poll, coming in at around the 55,120 crore mark. EBITDA, coming in at 5,600 crore versus our poll of 5,480. When you're talking about the profitability, slightly below our estimates. Console order inflows up 8.3% on a year-on-year basis. That is the good part. Remember, this is against a guidance of 10% for the full year. Now, also when you're talking about the core business margins, came in at 7.6%. Full year guidance is 8.25. The management, yesterday in the conference call indicated that they're sticking to the guidance for this point of time. One negative surprise that has come in is that the order prospect pipeline has dipped almost 10% on a year-on-year basis. That's the slight negative as a key takeaway.
All right, Vivek, thank you very much for that. SBI Life also reported numbers. Yash has got details. Yash, good, bad, ugly?
Well, Prashant, for SBI Life, it was a mixed bag. And even though it was a mixed bag, I'm going with a mild red on SBI Life. Most of the numbers, as far as the Q1 quarter is concerned, came in line with CNBC TV18 estimates. But the disappointment came as far as the margin front is concerned. On the margin front, of course, the estimates were anyway lower on a year-on-year basis. But the final number came even 100 basis points lower than our estimates and about 200 basis points lower on a year-on-year comparison. Now, the problem with the industry has been that the ULIP portfolio has grown very fast, which has negatively impacted margins for the industry. But for SBI Life, there was an additional problem again that came from the point of, term insurance or protection not taking off, which negatively impacted the margins for the company this time around.
Okay, all right. Thanks a lot for that, Yash. Well, I'm looking at JSPL, and actually the numbers, if you look at it, were better than what the street was working with. A couple of reasons. The standalone volumes were better, and the cost reduction continues. So let's run you through the numbers. The EBITDA number, much better, close to 200 crores better than what we were working with. Margins as well, a little bit better. It was a top-down beat, actually, because the standalone volumes came in at close to around 2.09 million tons. Most on the street were in the vicinity of around 1.9 to around 2 million tons. So India operations, better volumes out there, and that's one of the best quarterly volumes you've seen in a while. The standalone EBITDA per ton as well improved by more than 500 rupees on a sequential basis, so the street likes that. And the subsidiaries, exit the standalone business out there, the profitability improved, which explains why the EBITDA number was much better. They've reduced their net debt as well a little bit on a sequential basis, and they say they're on course to go ahead and expand capacity. Going with green because the EBITDA number looked much better, though the stock ended yesterday at the high point of the day. It's corrected close to 10% in the last 1 month or so.
Okay, so that is on JSPL. But what about IEX? How did that shape up? Vivek is here to tell us more about that. Vivek, over to you.
Well, good morning. IEX, a strong operational quarter, largely along expected lines. Remember, the company had given the Q1 operational update as well. So revenues higher by almost 19% on a year-on-year basis, coming in close to the 124 crore mark. EBITDA higher by 22%, coming in close to the 100 crore mark. Margins quite strong, 80.4%, higher by 200 basis points year-on-year. Profitability also higher by 27.2%. The other income component this time around remained strong, so 30.9 crore versus 23.4 crore that the company came in. Q1 total volumes that the company had indicated earlier up 21.1%, and the day ahead market price was something at 5.3 rupees a unit against 5.2 rupees a unit. This is despite the fact that there was increased sell side liquidity, indicating that demand remained quite strong in Q1.
All right, Vivek, thank you once again for that. IGL is the next one we want to focus on. Sonal has got details. Sonal.
Well, IGL has reported a good set of numbers. It was the margin beat that the street would like. Revenues declined 2%, but EBITDA was up 11%. Margins expanded 200 basis points. This is at the time when gas costs had gone higher. Profits also accordingly up 4.5%. Volumes largely in line with estimates, up 5.3% on a YOY basis. EBITDA per unit came in at 7.4 rupees versus an estimate of 6.8 rupees per SCM. And if we map it on the trajectory as well, last 3 quarters have continuously seen an improvement in margins. So going with green, and we'll get more color on the commentary as well when we speak to the management today. Okay, thanks a lot for that. So that is on IGL. But let's also talk about Sona BLW, because that company reported a very good set of numbers. And if you look at it, revenues were up almost 22%, very strong. They're led largely by the battery electric vehicle segment, which is the BEV segment. They've been large contributors to the BEV segment globally as well as in India, and that has helped them with their earnings. The EBITDA growth has also been very strong, 23% over there. Margins have been inching up quarter after quarter, now sitting at almost 28% margins, and the net profits have gone up almost about 27%. As I said, the electric vehicle segment is the main contributor for Sona BLW. So the BEV revenue growth came in at 53%, and the net order book for them now is at 23,300 crores, out of which 80% of the orders now have come from the electric vehicle segment. So that's the kind of traction that they're seeing over there. I'm going with green on that stock. But RBL Bank is also on our radar. Abhishek is here to tell us why. Abhishek, over to you.
Well, Sonia, sources do tell us that there is a block which has been launched at RBL Bank, and this is a huge block. So Bearing PE will sell their entire stake in the bank. They have about 7.9% stake in the bank, and the offer price is about 226 per share, which is at a discount of 5% to yesterday's closing price. The offer size is about 1,081 crore, which forms about 7.9% in terms of equity stake that they have in the company. IIFL Securities is the sole BRLM or book running lead manager to this issue. Back to you.
Okay, thanks for that, Abhishek. We'll keep an eye out for that large trade. Let's hop across to Vamakshi, who's tracking a couple of more numbers from the broader markets. Morning, Vamakshi.
Well, good morning, Nigel. Hitachi Energy reported a rather weak set of numbers. Revenue did see an uptick of almost 28%, but it came in nearly 21% lower as compared to street expectations. Even on a sequential basis, revenue has seen a bit of a dip, and that is mainly on account of cyclicality as well as higher traditional products in the revenue mix. But the operational performance, that was very, very weak for this company. In fact, that was much weaker than expected due to seasonality and this business mix. The EBITDA came in nearly 42% higher, but it was a 74% miss as compared to the street expectations. The margins too have seen a very sharp contraction on a sequential basis, much lower than what the street was expecting as well. Net profit, even though came in nearly 332% higher, was nearly 89% lower. So overall, going with the red for Hitachi Energy. But apart from that, when we look at JK Paper, the revenue from operations has gone up by almost 8.2%, and this is because the company increased sales volumes, which was largely driven by higher utilization in packaging and board business. Results were, however, adversely impacted due to significant drop in market prices coupled with surge in wood cost. EBITDA margins sharply contracted to 16.3%, and the net profit was down nearly 55%. So going with the red for JK Paper as well.
All right. Vamakshi, thank you very much for that. So it's a full earnings deck, and you'll hear from many of the companies that we sort of laid out numbers for here over the next 2 hours or so. We'll take a break. Deepan Mehta of Elixir Equities is going to be with us on the other side with some fundamental stock talk. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. We've listed all the stocks for you. Let's get some fundamental views as well going. Deepan Mehta, Director of Elixir Equities, joins us on the show. Hi, Deepan. Good morning. A rainy morning here in Mumbai, but plenty of stocks to track. Let's start off with the banking space. In Axis Bank, the asset quality issues have come back, and that's a little bit worrying. Though the street was bracing for a weak set of numbers, actually. What's your view on the stock? In all probability, it opens up in the red. What do you do from there?
Yeah, Nigel, good morning, and thank you for having me on your show. Yeah, disappointing set of numbers from Axis Bank, and even at the pre-provisioning level and at the net interest income level, I was a bit disappointed. But look, that's all in the price also. The stock is trading at a very cheap price to book, price to earnings multiple as well. So that will prevent a further downslide. But yes, I think across the board, so far, private sector banks have disappointed. Axis Bank, Kotak, HDFC, all have fallen short or slightly short of market expectations. And they're all constrained by liquidity issues because the way the deposits are not growing on one side and they have to pay higher for those deposits, that's having an impact on their margins. And the base effect as far as provisioning for bad loans, that base effect is so low that any further increases is leading to a sort of a hit on the net profit. So I guess this is a passing phase. And maybe 2-3 quarters down the line, once liquidity improves, you may see an improvement in their earnings. But at these valuations, doesn't make sense to sell because at the end of the day, they are great long-term secular growth stories, given that the franchise and the brand and the risk management systems will come into play when things improve.
Okay, Deepan, hi, good morning. What about L&T? How did you read into the numbers and, what is the recommendation for investors now?
Yeah, Sonia, good morning. I think very impressive set of numbers from L&T. And look, L&T is a complicated company, so you need to just remove the financial services and the IT businesses and then look at it on a core basis. And on a core basis, they are done exceptionally well. Slightly lower increase in order book position, but I think they are being very selective when it comes to new orders. But the underlying growth momentum, the execution certainly has picked up. And what I like best is the composition of the order book and the revenues is getting more diversified, especially coming in from global projects, which is very positive and more sustainable. Valuations are rich, but here's a company which can steadily grow for next several years or so. And it's a nice large cap company, good corporate governance standards, very good liquidity. So if you pay a little bit higher premium, I think it's well worth it. Having said that, it's a company in which we and our clients are invested in. So very positive on the numbers which have come through from L&T. And I feel that if you have a long horizon, like 3 to 5 years or so, this company can deliver very good returns.
Got that. One of the areas, Deepan, hi, morning. One of the areas which did very well yesterday, and I think on the day of the budget as well, it was insurance, right? So there was nothing negative. At the margin, there was a lot of chatter that something negative will come on insurance as well. Nothing. So we got that past hum. But you also had earnings, which so far have been giving us an indication that it's sturdy. Valuations are kind of undemanding. Do you own anything in this space?
Prashant, only one stock, LIC, and I'm really eagerly waiting for their numbers as well, because I think this will be a good quarter for LIC as well, being the largest insurance company. And steadily, they have been getting into more and more profitable products. And I think that the way the stock prices have moved up, as and when they announce the adjusted enterprise value, you may be surprised as to at what trading multiple or what price to book multiple it is actually trading at and how much of a discount it is. It's a similar situation like PSU banks versus private sector banks, and we had a fabulous rally in PSU banks as they caught up with private sector banks, and something similar can play out in LIC as well. So very positive on that particular company per se, but I think if you're holding any of the other insurance stocks, HDFC, SBI Life, ICICI Pru, I think all of them are on a very strong trajectory, and I think they should deliver a decent outperformance, especially if you have the view like we are that the markets are kind of topping off and there could be a correction around the corner. I think insurance is a nice defensive sector to be in, as is the case with, say, IT or pharma.
Deepan, yesterday you had that sort of study, a SEBI study which came, right? Talking about intraday trading and how many people lose money, etc. You combine that with the fact that there is also, there's been anticipation of the regulator doing something after taxes on stocks, but on the F&O side, something, maybe a consultation paper, etc. is around the corner. Stocks like BSE, etc. rallied. BSE was up 8% yesterday. Angel was up 5-6% over the last 2 days. What's your assessment for the capital market segment? And you combine that with the fact that your view is that maybe things are topping out a little bit.
Yeah, that's right. I think stocks like BSE, Angel, they are very cyclical. And last 2-3 years, we haven't seen any depletion in volume on the exchanges. At the same time, I think the stock markets have continuously rallied, and that has attracted many new investors and traders. But look, we've been around for a long time, and this is just unsustainable. At some point of time, you will have a cool off. It could be caused by regulatory action. It could be caused by external factors, like look at the way the Dow and S&P traded yesterday. That's not going to help the sentiment for today. And end of the day, you have to consider the fact that markets are slaves of earnings, and earnings are certainly slowing down. So of course, liquidity is taking stock prices higher, but at some point of time, there will be a balance as well. So I would say that stocks like BSE, Angel, other stockbroking companies are best bought in bear markets when the earnings are also under pressure. But apart from that, I would like to stay away from this particular category and just wait and watch and see how things play out.
Okay, well, thanks a lot. Deepan, just stay on. We'll come back to you in a bit. Anuj is also joining in to tell us what to expect from the market. Anuj, looks like it's going to be a tough day given the kind of global cues we have. There is still a little bit of a hangover from the higher taxation from the budget. Put together, doesn't look great.
Sonia, good morning. If it wasn't the post-budget kind of day, then I would have said that perhaps this could be a good opportunity for traders. But today is looking like a bit of a tough day because, we have a global mayhem in place. Biggest decline in Tesla and Nasdaq since COVID. That tells you the kind of setup we have. $1 trillion wiped out in US market overnight. $1 trillion. That's almost 20% of our overall market. And Nasdaq was down 3.6%. And the big question is this a start of some kind of global mayhem? As I said, our market anyway is going through our own corrective phase post-budget because of that taxation increase and the kind of hit that it led to on sentiment. The level to watch really is 24,074, the budget day low. That is sacrosanct. That has to hold. Today is also the monthly expiry. So things could get very interesting. There could be an attempt to recover as well because our market overall the trend has been quite good. But once again, it will have to be retail and HNI that will have to do the heavy lifting. FIs are not going to be there for some time. They've started selling again. Yesterday was big selling, 10,000 crores in cash and index futures put together. The bank nifty is below 20-day MA and the 20-day exponential moving average, even at risk of breaking the 50-day exponential moving average. So the market has to recover. IT and FMCG perhaps will have to lead that. One thing which has happened though because of the last 2-3 days is that the markets become light. The FII exposure on the long side has come down significantly from almost 4 lakh contracts down to 2.4 lakh contracts. And today's expiry, so even those remaining excesses will be cleaned out. And the put-call ratios also come down to 0.87. The India VIX has been falling. So there are a couple of positives to look for as well. In terms of index level to watch, the first support would be at 24,200 to 24,250. Looks like we'll start below that. That's the 20-day exponential moving average. And the big support is the budget day low, somewhere around the 24,050 to 24,100 vicinity. The bank nifty has been an extremely weak index. We've been talking about that. The next major support comes in at 5940, which is the 50-day exponential moving average. And if that breaks, then the next support is straight away at 50,000, the 100-day exponential moving average. That has been, of course, the weak index. The quote of the day is in line with what's been the talking point of late, which is on taxation. And if that is ready, then I'll leave you with that. If not, then back to you.
Okay, all right. We'll have that up.
We'll take that offline.
We'll take that off. Absolutely. There you go.
Oh, there it is. Okay.
Yeah. Taxation is a price which civilized communities pay for the opportunity of remaining civilized.
All right.
I won't say more than that.
Oh, got it. Well, point taken. I think we'll come back with more in terms of the markets, etc. But I think that's a sort of nice segue into a quick commercial break here. Up next, we'll have Vikas Gupta of PG Electroplast. PG Electroplast, stock's done phenomenally well. Was up 8% yesterday. The company's raised their revenue and net profit guidance. So we'll talk about that and more with him on the other side.
Bank of Baroda 117th Foundation Day celebrations. Trusted today, transforming tomorrow.
Swastra India has been having a long association with Bank of Baroda since 2010. We started with 50 lakhs of turnover and reached 60 crores in the last financial year with the great support of Bank of Baroda. Especially the management team has been a great support. During the COVID time, we all know how badly it hit us. Bank of Baroda supported us quickly, and with that support, we were able to overcome the crisis. I take this opportunity to thank Bank of Baroda for such an amazing support. I'm extremely happy about the growth of Bank of Baroda over the year with their people, process, tech platform, customer service, one of the best in class. We are looking for strong association in the coming years with Bank of Baroda.
Bank of Baroda 117th Foundation Day celebrations. Trusted today, transforming tomorrow.
हमने लिए 90 लाख में, आपने लिए 80 लाख में।
ये सेम क्यों नहीं? क्योंकि आपके और हमारे होम सर्च ऐप सेम नहीं है। जानिए प्राइस ट्रेंड्स और सही ट्रांजैक्शन प्राइसेस on 99acres.com.
Helps beat sensitivity fast. Sensodyne Rapid Relief.
PhonePe proudly presents Share.Market. Open a Demat account by 31st July and get zero brokerage till 31st December on FNO and intraday, equity delivery, wealth baskets, and zero account opening fees. Download Share.Market and start investing.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
Well, as promised, PG Electroplast is the first management on the show. The company reported a good set of Q1 numbers. Revenue growth was led by a growth in the products business. In fact, the product business grew by 124% year-on-year and contributed 75% of the total revenues in Q1. To discuss this and more, we have with us now Vikas Gupta, who is the Managing Director of PG Electroplast. Mr. Gupta, good morning and thanks a lot for joining in. You know, I wanted to ask you about your overall growth guidance that you have revised. Can you tell us what is both in terms of revenue as well as net profit, your guidance has been revised. Now you're looking at a growth of 33% year-on-year in FY25. Can you tell us what has led to that, very strong growth expectation? And going forward, which are the segments that can contribute to this kind of growth?
Good morning, Sonia. I think the major growth driver for our business has been the focus that we have on our product business. So definitely air conditioners is one of the big dominating category in our product business. And I think all other business categories also like washing machine also kicking in. So our guidance revision is based largely on the growth in our product business. We are targeting a growth of almost around 60% in our product business to almost around 2,650 crores coming from our product business in the total revenue guidance of 3,650.
Okay. Within the product business, of course, we do understand that a large chunk of it is coming from air conditioners, especially room ACs. And we're starting to see a lot of first-time buyers in the air conditioning market. Can you tell us a little more about that? Is it more in tier 2, tier 3 cities? Are you seeing a broadening of the buyer base? And how are you planning to scale up this vertical? Will you be, putting in more capex? Will you look to increase your capacity?
Yeah, so this is basically a very interesting phenomena that we have experienced in AC market. And there are a lot of first-time buyers which are coming into buying ACs. And we all know once one AC comes into a family, then there is expansion of that AC category in a particular family. And you will start adding ACs into different rooms. So we are seeing a very secular growth in air conditioners. And to harness that growth opportunity, we are further expanding our capacities in our air conditioning business. We have already started our capex cycle for putting our new plant in North India for expanding our air conditioning capacity. We are further enhancing our capacities on our plant in Maharashtra. So we are further ramping up our capacities in ACs.
Hi Vikas, good morning and good to see you. Ben, some part of the street believes that the stock was very, very expensive, but now it appears you're going to do more than 200 crores of PAT and then you'll do 300 crores at the times to come. And then if you look at it at a market capitalization of 10,000 crores, you're trading at around 30 times. That's the bullish argument. But let's get a couple of more details. You're talking about product business growing by 60%. When you joined us the last time around, I think you had given us a couple of numbers that the RAC business, I think, will grow by close to 30-35% for this year at least. And the washing machine business will be around 40%. So break it up for us. The product business itself, you have up the guidance. So what is the breakup between both these two large segments?
So, Nigel, good morning. For us, the air conditioners will be contributing more than 60% of growth based on our previous year performance. So we are targeting a revenue of almost around 2,150 crores coming alone from air conditioners. Washing machines will be again almost at around 40 to 45%. We are expecting a revenue of almost around 450 crores from washing machines.
Got it. There's a bearish argument as well that because of the introduction of PLI 2 for room ACs, and since we already have a lot of capacity that's coming on stream, it could lead to overcapacity. What's your argument to that? Because the point is that could squeeze margins as well as pricing. Respond to that.
So Nigel, I would say we are very bullish on AC as a category. In fact, we are planning to participate again on the new window of PLI scheme which has opened, and we'll be definitely putting in our application there. And what we feel, I think the argument is there is an expansion in capacity, but we are trying to see that we have the kind of traction that we have with our clients. And we have already started discussion with other clients for the summer of 2025. And we are seeing a very robust and very strong interest from all our clients.
See a problem of overcapacity, right?
We don't see any problem of overcapacity as of now. And we feel that we will be growing at a healthy pace in coming years as well.
Because I was looking at the presentation, morning Prashant here, sometimes, quarter, you kind of lose sense of the long arc of time, right? The presentation says growth has been 10x in 8 years. Revenues of 260 crores in FY16, 2,700 crores in FY24. So you're doing, of course, many things right there. Because last time we spoke, you did hint that you will enter a new segment, a new but allied segment to what you currently do. Can you tell us now, what is that segment? Have plans been firmed up?
Good morning, Prashant. Right now, I won't be able to share much details on that. Plans are still under discussion. But definitely, we'll be further looking at growth opportunities in allied product category. And we are trying to build our capacities based on that. So we'll be coming out with some kind of information on that in due course of time.
Will it be in this quarter, Vikas? Can we expect that? And is it a large sort of market in that sense, which significantly steps up growth?
So definitely it will be a large category only where the headroom for growth is significant. We are looking at that kind of product category only. It may happen within this quarter, it may happen in coming quarters. So we have to keep our fingers crossed on that.
Okay. I just have one quick question. Any plans for AC compressor manufacturing? I think compressors are still being imported at the moment. So any plans for manufacturing compressors?
So Sodium, this is kind of a product or a component that we are very dependent on for importing from China. Definitely, this is one component or a segment that we will like to explore. And because in this case, we are dependent on a provider of technology from some overseas vendors. And we are in discussion with a couple of companies. Let us see how it works out.
Okay. And any scope to increase margins further?
We would like to maintain the margin guidance as we have revised at a PAT level of around 215 crores. That is what we would like to maintain that way.
Okay. All right. We'll leave it at that. Thanks a lot for joining in. That's PG Electroplast with their view on the business. But let's now get you some conversations we had with the budget makers. Revenue Secretary Sanjay Malhotra says that the government is expecting revenues of around 17,000 crore rupees from capital gains tax. Finance Secretary TV Somanathan also says that the 12.5% tax on long-term gains is intended to be the destination and not a transit stop. He termed the hike in STT as a mild nudge. Let's listen into a few excerpts from that conversation.
With this slight increase, especially on the short term, there is hopefully we will end up getting more revenues, both from STT buyback and from the changes in the capital gains.
So what could that 1 lakh crore rupee number look like?
So we are expecting from the capital gains about 17,000 crore. What the future holds, insofar as rates are concerned, as far as my understanding goes, there cannot be a certainty. What we can actually make certain for you is that there is no retrospectivity. There is no retrospective taxation, and that we have been very conscious about when we make our tax laws.
But Mr. Somanathan, yesterday when I asked you this question...
I'll give you my answer, my own answer to that, and he's right. He's giving you the correct answer. My own answer is, as of now, I do not see a prospect of this being changed in the near future. I think if there was an intention to go further, it would have happened now. And it is certainly not the intention right now to go any further on this. But I cannot speak for, I said that too yesterday, that I can't speak for, switches. The intention is, this is not intended, as I said yesterday, this is not intended as a transit stop. It is not as if we are trying to do it in 6 monthly installments. Okay, we start with this, then we, no. It was intended to be an integration of all at one rate. And remember, we have chosen that one rate also to be neutral to the other asset classes, which is why we chose 12.5%. Right? I mean, we did 12.5%. We would have preferred 15%, perhaps, at least me individually. But 15 would have been definitely a rate increase for certain other classes, where after indexation it would have been more. So therefore, we took a view. I mean, we don't take these final decisions, but at least my personal view was that 12.5 is a good balance. So that balance remains good at this level. And so there's no immediate intention to change anything. This is intended to be the destination.
Okay, well, time to slip into a short break. Up next, we'll get our technical experts with us. Sachidanand Utekar as well as Sudarshan Sukhani will be joining in.
Okay, welcome back. The only question is, should you be attempting to try and buy the dip, or should you just sort of stand aside because it's a bit of a cocktail of things, right? Let's put that question to Mitesh and Sudarshan, who are with us with specific trading strategies. Actually, we have Sudarshan and Sachidanand Utekar joining us today. Gentlemen, good morning. Great to have both of you here. Sudarshan, your perspective on things, and I mean, at some point, does the budget day panic low come into view? And the question is, will it hold if it does?
Yeah, good morning. The budget low apparently should not hold. Now, I can't say whether it will not or it will. My sense is that it will not hold. If not today, then probably in the next few days. Because what happens now, Prashant, is that we are going to follow international cues. All our local news has come and it's done with. Internationally, charts are weak. The markets are suggesting some kind of a correction, and we are going to follow that pattern. So there is no trade here. We don't want to buy this dip because we don't know if this dip is the dip. We have to wait patiently for the markets to settle down. That takes some time, maybe a couple of days, 3 days more. So don't buy anything, just be patient.
Buy anything, just be patient. I guess that's a good way to do it, considering that we haven't got any major dip up until now. Sachidanand Utekar is also with us. Sachidanand, is it just the best thing to do, just perhaps take a step back and watch how this plays out? Or do you have a strategy for today?
Good morning, Sonia. Good morning, Prashant. I think, I do concur to the view which has been expressed here. But if you look at, from today's point of view, the 24,000 support looks very strong, and probably we may see the Nifty, opening and slipping towards the same. But I think the data is supporting the fact that this particular support may act as a good buying opportunity for the day. We may see a rebound which may shape up in the second half, and probably we may see the expiry somewhere close to around 24,230, 24,300 kind of a range itself. So we are not expecting that 24,000 would be at threat, at least for today's trading session. The recovery is something which will be important. There's a clear-cut, low top, low bottom sequence on the 60-minute scale. The Nifty has been trending lower below its 5-day exponential moving average. So the strength overall will develop only once Nifty starts trending confidently above the 24,560 mark. So I think this particular level will act as a resistance, but support at 24,000 should hold.
Okay, all right. Good morning, gentlemen. Well, Sudarshan, you go first. Tell us the stocks that you're tracking for today.
Yeah, I have two buy ideas, and they are buy ideas not for today, but they are essentially positional trades where we can buy the dip. One is Coromandel International, consider buying with a stop under 1530. And the second is ICICI Prudential, which had a big run up yesterday. Hopefully that will cool down today. So you essentially buy the dip with a stop under 625. I have two intraday shorts. First is Axis Bank, sell with a stop above 1280. And Bajaj Finserv, sell with a stop above 1610.
Okay, and Sachidanand, what about you? What would your stock ideas be for the day?
So there are two stocks on the long side. I would avoid shorting the market, at least for today. When we look at the structure of India Mart, it has clearly displayed a very strong breakout from its 6 months consolidation. If you look at the 60-minute scale, there's a classic bullish flag formation in progress. The pattern target is placed somewhere close to around 3,300, which will be on a positional basis. But even from a trading perspective, any declines towards 3,000, would give another opportunity to create aggressive long position there. From a trading perspective, we are expecting a move towards 3130. The stop loss for the trade should be placed at around 2940, and any decline towards 3,000, one should try to build more aggressive long position there. The second stock on the radar has been Lupin. Now it has been trending near its life high zone. Yesterday itself, we saw some more short covering moves. The 1800 support has been holding on well. So probably we may see an extended move towards 1870 sooner. So I think any declines here should be utilized to create long positions. 1785 should be a stop loss.
All right. Sachinand, good to speak with you. Sudarshan, great getting this get that perspective from you as well. We'll speak again shortly. We'll take a quick commercial break here. We'll come back with the pre-open session, which is just 3 minutes away. We'll also have the management of DCB Bank. We put the focus on their first quarter numbers on the other side. Stay tuned.
Welcome back. We're just heading into what could be a really challenging day of trade. Chandan Taparia, the derivative and technical analyst at Motilal Oswal Financial Services, is joining us now. Chandan, doesn't look good at all. In fact, the Nifty now in pre-opening is down 350 points. What does one do and what are the stocks that you're looking at today?
Good morning, Sonia and Prasant. Thanks for having me. So we have seen a volatile swings in last 2-3 trading sessions, and now resistances are shifting lower. We witnessed that on last trading session, the Nifty remained in a range of 200 points, but follow-up was totally missing. And now the hurdle is clearly visible. But the good part is that India VIX has corrected by around 25%, which might provide some support at lower levels. But as of now, the way index has taken hurdle at higher levels and couple of database are indicating some negative bias, including FI's long-short ratio, decline in the put-call ratio, the index can drip lower. So as of now, 24,200 is the immediate support. Below that, it can open the downside towards 24,000 zone. So now we need to look at the hurdle zone. Till Nifty doesn't surpass 24,600 zone, one need to be light and bounce could be sold for the downside move towards 24,200 and then it can open the downside. Now talking about the Bank Nifty index, here we are finding some sort of concern. Recently, it has taken hurdle near its rising channel and started to form lower top, lower bottom. We have seen some call writing and it drifted below its key moving averages. We have seen a consolidation breakdown of last 10-12 days below 51,750 zone. So now till it holds below 51,750, some more weakness could be there in the entire BFSI segment and it can drip down towards 50,500 to 50,000. Now looking at the stock wise, we have to be very selective now again in the market scenario. But again, selective pockets can do well, which are having the lower beta. So first that is buy on NTPC. We have noticed the stock is holding well, comparative market volatility. It has given a consolidation breakout of last 35 trading session. So recommending to buy with support of 382 and NTPC can scale high towards 410 level. Second trading area, there is buy on granules. We have noticed a positive price pattern, which is similar to a pole and flag, which has bullish implication. It managed to hold key moving averages and selective Nifty pharma stocks are doing well. So recommending to buy on granules for an upside target towards 561 can buy with support of 525 level. Last trading idea, that is sell on Bajaj Finance. We have slightly negative on the entire BFSI segment, including Bajaj Finance, Bajaj Finserv, counter like Axis Bank, IndusInd Bank, Kotak Bank. So Bajaj Finance looks weak. It has given a breakdown of the last couple of days. Negative price pattern with built up of short position with negative rollover indicate downside could be there. So one can sell with hurdle of 6750 and we are expecting it to dip down towards 6300 zone.
Chandan, thank you very much for that. Sonia, you were talking about challenging market, right? You remember what Naren told us yesterday? I mean, actually, it was a wish. He said that we need some more volatility in the market. And then immediately after, he said some down move, something. Wow. And that is coming from one of the largest money managers. But also, he's done it for 30 years. So for the old timers, right? I mean, what we've seen is actually unnatural. I mean, as Deepa also pointing out.
And a lot of people are waiting for this fall. To be honest, it hasn't come in since COVID, I think. Since the COVID recovery.
Not that anyone is asking for a big correction or anything, but a more normal kind of,
decent correction.
Global, it's not nothing bad. I mean, global markets are bad, you react. It's not like you completely Teflon coated and everything you throw, the market just kind of shrugs off and sort of reacts in one way, which is, of course, up and up and up. Deepan, of course, is still with us. Deepan, I don't know if you want to add anything to that, but it's interesting, right? I mean, the times that we are in. So comment on that, but also comment on names like CG Power, where I think we've had numbers come through. There is acquisition as well. We'll be, by the way, joined by the management later. You had some of these budget-related stocks which continued to move higher. HBL Power was sharply up. HCC. I mean, there was that nuclear angle, and India, of course, is one of the few countries which is building up nuclear capacity in a big way. Borosil Renewables. You heard from PG Electroplast, which they've raised their revenue and profit estimates. Go on, Deepan.
No, I think that correction can be around the corner. It can happen at any point of time in a bull market. In past bull markets, I've seen 10-15% sell-offs also and then pick up after that. It's just that we are seeing such a flood of liquidity coming in, so one can't really predict that despite such high valuations, there is no serious correction, but we could be surprised on that count as well. But by and large, I think there have been very few outliers in this earnings season, and there have been a lot of disappointments. Also, the companies which you named, like HP Electric and CG Electric, these are all, end of the day, very cyclical businesses. And now they have a superb upcycle, no doubt about it. But you cannot pay such huge P multiples for such businesses, I think, which are not really secular over a longer period of time. And I think like to be a little bit underweight and a bit cautious in the markets.
Okay, all right. Thanks a lot for that, Deepan. Wishing you a good day ahead and look forward to chatting up with you rather soon. Well, let's get to our next management on the show, DCB Bank. The deposit growth, well, that was strong. The problem is on the NIMs as well as on the slippages. To understand more about what went on in the past quarter and what's the way ahead, we have Mr. Praveen Kuti, the Managing Director as well as the Chief Executive Officer at the bank, who joins us. Good morning, Praveen, and good to see you, and thanks a lot for joining in. Well, let's get your view on both these two factors. Your quarterly annualized slippage ratio, well, the run rate has been more than 3% for the last many quarters, close to 14 quarters. Tell us what's the guidance on this number going ahead. In absolute terms, I think it was 370 crores. So what's the way ahead? And also on NIMs, because both these two are the problem pockets.
Right. What I would like to talk to you about is that in Q1, which is a difficult quarter, where liquidity was tight, we've grown the deposit 20% plus YOY, and the loan growth also has been up to our expectations, 18.9%. On the NIM front, there are two factors at play. One factor is that our long-term deposits booked 2.5 years back, 2 years back, are coming up for renewal, and they're getting renewed at a much higher rate than what they were initially contracted for. So this trend, I would expect to continue maybe till mid of Q3, after which the growth in volumes would reflect in growth in non-interest income. That's only one part of the story. The other part is that we have had one-off interest hits on account of the penal interest now being substituted as penal charges, and secondly, on penal interest, interest reversals on account of demand draft disbursals being accrued from the time of disbursals, moving on to the time the demand draft is handed over to the customer. So this cleanup has happened largely in Q1. There'll be some remnants left in Q2 as well, but after that, one expects to see the NIM to rise.
Right.
On
so
your
Praveen,
second point, which is on the slippages.
That's right, Praveen. If you could give us a couple of numbers, then you're expecting the NIMs to improve. Explain to us why it was under pressure. Give us the range then for the year. What should the NIMs look like? And you were getting to the slippage numbers as well. Please go ahead.
Our guidance continues to be between 365 and 375. Currently, it's at 339. We'd expect a bounce back in Q3, and I don't see any change happening on that count, even after taking into consideration the increased cost of fund stabilization happening in Q2.
Okay. Mr. Kuti, so on NIMs, could you give us a sense? What would be some guidance would be helpful, sir.
365 to 375.
Okay,
365 to 375 on a steady state basis.
Got it. And in terms of the...
On a steady state basis.
Okay. In terms of slippages and non-performing ratios, what would the guidance be?
Sure. So what we see is that while we would like the slippages to be below 2.5%, the segment that we operate in is such that the slippages are elevated, and so is the recovery in upgrades. If you see even the last quarter, our recovery in upgrades was 77% of the slippages. In quarter 4, it was 95%. So a significant portion of the slippage is because of gold loans, which are small ticket nature, and they are overdraft. So the discipline of payment is not, is not regular every month, but it's in a sporadic manner. So we're getting the customers to change, but we're talking about a large customer base of gold loan where there is lack of discipline. There may be delay, but no denial.
So so actual credit loss is very low in that segment, right?
It's extremely low. I mean, if you were to see the total NPA on a stock of close to 5,000 crore is about 44 crores in the last quarter, in June 30th. And the aging is very, very limited there. So, but the nature of the beast is that the slippage will be slightly elevated, and so will the recoveries be.
Okay. Praveen, I wanted to understand in terms of loan growth, right? What kind of sustainable loan growth are we looking at in FY25 and FY26? And which is the segment that will contribute the most to loan growth?
I expect us to grow double the book in about 3.5 years' time. So even if we were to look at the current rate of growth of 19%, between 19 and 20%, we should reach there comfortably. The segment that we are concentrating on continues to be secured. Mortgages is a big play. Within mortgages, LAP, business loans, are a critical thrust area for us. Within the SME segment, we're going to concentrate far more on overdrafts as compared to normal lending to the MSME segment. The ticket size will continue to focus on less than 1 crore. So you will see an elevation in ticket size also coming through from our stock as well as incremental loan portfolio is concerned. But clearly, self-employed customers, MSME customers are the focus area, and secured retail small ticket lending is the credo.
Yeah. Okay. All right, Praveen, before we let you go, when does the slippage ratio come down to 2.5%? That's where you see it headed. So by when, if you could give us a guidance there? And what about your return ratios? Do you see the ROEs continuing in this vicinity of around 12 to 13% in the coming year?
No, I would tend to see that the 2.5 is something which you are gunning for in about, it'll take about 6 to 9 months' time. So we should see the slippages coming down. As you see, the gold loan, if you were to exclude the gold loan, that comes to about 2.2 to 2.4%. That's a slippage. But on the gold also, we are trying to instill the discipline by institutionalizing standing instructions, ECS, etc., so that the discipline is somewhat replaced by a system-based repayment coming through.
Okay, Mr. Kuti, we'll leave it there for now. Thank you very much for joining us to talk about the numbers, and we'll love to have a more detailed chat later. Thank you very much, sir. So we're just sort of running through to market open. If you can have the pre-open prices come up, just look at two names. One is Axis, the other is L&T. And just a quick look at the Nifty in the pre-open as well. And we'll go to the 9-10 calls. Axis is down 3. And I think you've got L&T, which will come up as well. It's up about 0.5% or so. The Nifty itself, of course, is settling down. It's settled down about 180 points lower. So, Darshan, what are the 9-10 calls?
Well, consider going an intraday short in Bajaj Finserv with a stop above 1610. Adjust the stops accordingly.
Okay, well, Axis Bank is your big loser in trade. It's down almost 3%. Abhishek is here to tell us why. Abhishek, over to you.
Well, Citi has downgraded Axis Bank to neutral with a target price revised to 1,320. They say that the asset quality has surprised negatively as seasonally high slippage of 2% coupled with weak recoveries and upgrades led to elevated credit costs. So credit costs did come in at 1% while they were penciling a credit cost estimate of 0.45%. That led to earning miss as well. So reported net interest margin, although flat on a sequential basis, was led by the fact that there was one-time gain of 7 basis points with interest reversal that they had on the IT refund. So seasonally modest deposit growth pushed the credit deposit ratio to 92% as it tapped opportunities in corporate advances, which grew by 5% on a sequential basis. This led to total advances growth of 1.6% on a sequential basis. So a fall in OPEX supported the return on asset, which came in at 1.65%. Factoring in higher credit costs, they have revised their earning estimates over the next couple of years. Back to you.
Okay, thanks a lot for that. Well, Sonal is with us to talk about Petronet LNG and why you should be watching that one. Sonal, over to you.
Well, Petronet LNG reported good set of numbers during market hours yesterday. We got more details where volumes were up 14% on a YOY basis, which was led by higher third-party sales. Marketing margins on spot LNG sales came in higher at 180 crore rupees. There were inventory gains of 260 crore rupees. The hedge utilization at 109% is a positive, and they expect it to continue at 100% in FY25 as well. The hedge expansion by 29% will be value accretive, and they've guided for a capex of around 3,500 crores in FY25. Brokerages, they are mixed. Some of them are positive. Nuvama has raised EPS estimates, so has MK. But Jeffrey says they say it's a one-off, and they will see some deterioration going forward.
All right, just a few seconds to go for the market open. Not seconds. There we have it. 150 points lower, 24,253. 50 is where we are starting. And that's about 0.6% lower. Nifty Bank is down about 0.6. It's about 340 odd points down. Almost immediately, there is a bit of a recovery which seems to be setting in. I mean, just to begin with, it is not as bad as what the GIFT Nifty was indicating. I mean, at one point, I think there was a much larger cut. So it's almost actually much better at the word go as well. The mid-cap index is down about 1%, and I think the small-cap index will come up on your screen as well, which gives you a sense. 2:1, declines outnumbering advances at the word go. RBL Bank block deal has gone through. Stocks down about 3% or so, but all about stocks, Anish.
It is. Axis Bank really is the one that's taking it on the chin this morning, down 4.5%, post a weak set of numbers, and brokerages have downgraded the stock as well. L&T on the flip side, though, is up 1.5% post its numbers. SBI Life is up 1.5%. Tata Motors is holding up after a Nomura upgrade that has come in on the stock with a 29% upside to the current market price. So Tata Motors is holding up in a falling market. But a couple of other stocks, RBL Bank, as you mentioned, almost 8% equity has changed hands. So that stock is now down almost about 3% or so. A couple of other names to look at. In terms of pressure on the market, the Bank Nifty is exerting pressure, down about 1%. You have ICICI Bank, that is your top loser right now after Axis Bank in the banking space. And then a couple of other names as well that are not looking that good. In the broader markets, plenty of stocks to talk about. But I think the big losers are some of these erstwhile gainers. So Zomato, some money being taken off the table there. Canara Bank, Irida, South Indian Bank are under some pressure. RBL Bank, we spoke about that. Vodafone Idea is down about 2%. But on the flip side, on the upside, you have names like MMTC that are doing well. But yes, it is a weak start to trade.
Well, that's right. One of the managements that just joined on the show, PG Electroplast, they're one of the few companies that have gone ahead and increased their guidance. So PG Electroplast is now up close to 10%. Massive move is what we're seeing out there. A couple of other notable gainers. Suraj Estate is up close to 5%, so that one as well comes up for you on the screen. Struggling to find too many winners today. But in terms of losers, you have JSPL. The stock ended yesterday at the high point of the day. Today, the stock is pulled back. Metals on the whole as well have been weak, so the stock is down close to around 4% or thereabouts. Hitachi Energy, let's get that one as well up. Those numbers were quite disappointing. The longer-term story may be intact, but the margin compression is something that the street would not have taken too kindly. So that one is down close to around 2.5% odd. You have Oracle Financial. Well, last few days, the stock actually was quite strong, and it's seen a fair bit of delivery-based buying as well. But Oracle today, it's down close to around 1.5%, although those numbers look quite good. The EBITDA was up by 36%. You had margins as well that expanded by 600 basis points odd. Mars Financial, the NIs were up 29%. The net profit was up by close to 23%. And that stock initially had opened up well in the green. So pull up that one as well up for you. And RVNL, they've got an LOA for a contract worth 200 crores from Southeastern Railway. So I think the initial tick as well out there was a little bit in the green, but that's moved into the red as well. Craftsman Auto, that's the other one I'm looking at. EBITDA is down by close to around 8%. The margins contracting by 400 basis points. Maybe that one as well should come up for you on the screen, pulling back as we speak.
Oh, absolutely. I mean, lots happening, right? 170 lower on the Nifty is what we have. We're at about 24,280 and, enough and more action, which we will continue to talk about. Let's just look at the other three indices, Nifty, Bank, Mid Cap, Small Cap, and then let's go across to our market master. So Mid Cap, Bank Nifty is on 1, and the small and mid cap indices are on your screen, 0.5% lower at this point. But this is still early days in terms of the price action so far. Life insurance, I was discussing this with Deepan earlier, is I think again a space where there is some green activity. SBI Life, of course, reacting to numbers, but ICICI Pru was a big mover. Max Financial, etc., were also others which did quite okay for themselves. Anish Tawakle is with us. He's Deputy Chief Investment Officer Equity at ICICI Prudential Mutual Fund. Anish, good morning. Great to have you with us here on the program. It's always a pleasure for all of us here to be speaking with you. Anish, now some time has passed with the budget. We've heard from the secretaries. We had a town hall yesterday. What is the what's the sense across actual implications? So we spoke with Naren yesterday, who was talking about debt mutual funds, right, not being a preferred asset class anymore, even from a taxation kind of point of view. So you would have had some time to digest all of this, speak to your I don't know if you've spoken to investors at large, but I want to start there. Anish, go on.
So the way I see it, the most important thing that I wanted from the budget was it does no harm. And this budget clearly meets that test, right? Basically, my concern was that if the budget spends, the budget deficit is high, if we don't have fiscal consolidation, then the economy would overheat, right? And we'd have severe inflationary pressures building up. So at a point where the economy is in good shape, right, it's best to let things be, and the budget does a good job of that. The economy has momentum, that momentum should sustain, and not much tinkering was required with the economy.
No, I think, Prashant's question was more towards what the normal retail investor would do from here on, because taxation across the board has gone up, right? Long-term, short-term, STT, taxation on property. So this sentiment overhang is something that could linger on for a bit, you think? And how does one approach it from here?
Look, taxation has gone up a bit, but it's not unreasonably high, right? It doesn't, if the economy is doing well, if earnings growth is good, I don't see why people should step away from investing, particularly longer term investors, because tax rates have gone up by 2.5%. Short term trading, I think the regulators are concerned about, and if that moderates, that would be a good thing. There is too much short term activity, particularly in illiquid stocks. And that is never good for the market. So that abating would actually be a good thing. But I don't see why a 2.5% or a 5% change in tax up to, say, these levels that they've gone up to should really deter long-term investors. And I haven't seen any of that sentiment expressed by anyone.
Yeah, no, you look at equity specifically. Got it.
Just in equities.
I think that we're having the audio perhaps was cracking a bit. But let's give this another shot. Anish, in terms of flows between debt and equity funds, do you see, in any case, it's not as if, flows into equities were strong, debt, nothing at all. And people, fund houses like, for example, Naren has said many times that, debt is an important part of the asset allocation process it needs. But of course, tax in terms of just as a taxation component, it's discouraged. What has happened? So I'm just trying to understand what happens to flows. Do you see more coming in, even more coming into equity despite the taxation increase here? Because
so Prashant, look, I'm not really an expert on flows. These flows, I think there's reflexivity in the flows. That's clear, right? So as long as the markets are doing well, they attract more investors. And that is something to be concerned about. It's not something to celebrate, actually. So the flows, I think, will remain reflexive. If the markets weaken, you will see a weakening of flows. If markets remain strong, flows will remain healthy. I don't think a 2.5% change in tax really changes, sentiment too much about the attractiveness of equity per se.
No, absolutely. There is, if you're investing, then of course you don't want it. You don't want any tax increases, but it is what it is, right? And markets will deal with it. But let's talk about the market itself, Anish, now. So where are we at in the cycle? Because every time we speak, we are 1,500 points higher. So where are we now?
So I think, look, the market has had good earnings support, and that's a good thing. We have been of the view that, look, risk-return trade-off remains better in large caps than in small and mid caps, and that view remains. I think we have concerns about small cap growth in the market, but from here on, see, I think the earnings growth should remain healthy, but it will moderate. So we've gone through a period where earnings was seeing the benefit both of volume increase in a recovering economy and profitability improvement, right? So our businesses were seeing both good volume growth and profitability improvement due to operating leverage. The second part of it, right, we continue to expect good volume growth to drive earnings, but we think profitability is in many sectors now close to peaks, and profitability growth will no longer be as big a driver of earnings. So we expect some moderation in earnings growth from here, and that means, like, at least over the short term, we are not expecting mega returns in the market. On the short term, we would be relatively conservative.
Some have pointed out in Q1 so far, what we've seen in earnings, there's actually a very sharp slowdown in earnings momentum. Would you agree with that, or you saying this is expected deceleration?
Yeah, so we were, as I was saying, right, FY24, right, saw both ROE improvement and volume growth. So that's second part, right? ROEs do not keep improving to infinity. So we were expecting some moderation in the profitability improvement. Profitability is still healthy, but it's not going to improve as much further. So that was expected. What we are also seeing is some of the financials showing some reversal in the very strong asset quality trends that we had seen earlier. And I think that is the interesting bit to watch, right? How asset quality behaves in the financial sector, particularly in the unsecured retail segment going forward.
Hi Anish, good morning and good to see you. And what about the metals pack? There was a lot of interest at the start of this year. That seems to be fizzling out a little bit. The Chinese data is not looking so good. And some of these stocks have come off 10-15%. Stocks like Hindustan Copper actually are down more than 25% from the peak. What's the view out there? Because sometimes when these prices correct, the price can't fall below a particular level. And that's when we see a bit of a rebound. So how are you positioned out there?
So, I mean, my portfolios are public and quite light on metals. I have been of the view that, peak China demand will continue to contract. And particularly, on the ferrous side, right, ferrous metal side, iron ore supply is increasing, right? Brazil is coming back into the market. Brazil had been out of the iron ore, had been having production problems in iron ore for a while. And Brazil is coming back in the market. So basically there is softness in iron ore prices, and steel prices are basically the sum of an iron ore price plus a conversion margin. So even if the conversion margin is healthy, the softness in iron ore prices is what we need to watch out for.
One stock, by the way, which is bucking the trend today is Tata Motors. It's up about 1%. We were just telling you about how Nomura has upgraded that stock. And, Anish, I wanted your thoughts here because Nomura...
I can't talk on single stocks, so
sure,
I'll
of course.
from commenting.
I completely understand that. I want your thoughts on the sector overall because, this is one space that has been doing pretty well. And now some of these luxury/premium side of the market is picking up, especially in some of the global markets. So I wanted your thoughts there. As a percentage of your portfolio, as an allocation to your portfolio, would you top up on autos or are you a bit cautious here?
Oh, so we've had a lot of autos in the portfolio. But, one of the principles we follow is that as stocks move up, we reduce our positions. If you like something at 100, you should like it less at 200. And that's what we've been doing on autos. And if you look at the numbers on autos, right, basically that's a prime example of a sector where you've seen both volume growth and a margin or profitability improvement, right? So if you look at any company and you look at the profit per vehicle, that would have gone up a lot. I mean, so that profit per vehicle will not increase further is the way one should think about it. And now you'll only get volume growth. So as long as the economy is healthy, volume growth will be healthy, but, one needs to be reasonable about what kind of margin improvement one builds in from here. Because the sector is competitive. I mean, there are a lot of automakers, there are a lot of car makers, there are a lot of two-wheeler makers. So the sector is competitive. And one has to be, reasonable about what kind of margins one forecasts in this sector.
If you like something at 100, you should like it less at 200. That's value investing, right? I mean, I know people will say, well, you buy it at 100, goes to 200, double up.
That's not what we do at
I know. So let's talk about IT services. Where are pockets of... what you're saying essentially is at a portfolio level, right? Keep bringing down... I mean, I'm using PE as a valuation metric. Keep bringing down average PEs, right? I mean, keep PEs at a reasonable level across. Book profits would have become overheated, and that is good advice if you're doing it yourself as well for viewers who are watching.
Yeah, so in general, basically, laws of economics works, profitability does not go to infinite levels, so don't build in expectations of forever rising profitability in any industry.
So I'll give you an example, right? We had PG Electroplast management, again, not talking about companies at all, but using it as an example. Stocks done extremely well, valuations were looking very rich. They've raised their FY25 profit revenue estimates. And if you build a 30% growth and look at FY26 estimates, stocks are trading at about 30 times earnings. Profits have gone up 10x over the last 8 years. I'm not asking you to say this or that.
I really won't comment on this specific company, but the reality is, look.
Because there are specific sectors where there is a tailwind as well. I mean, there is government spending, focus, new categories in local manufacturing opening up, and all of these companies are trying to do everything. Companies used to do this. I mean, some used to do ACs, others used to do phones, but now it's basically everything. And it's a large enough space. So I'm just trying to understand, how would you approach some of these things where there is growth and it's coming? Yeah.
Look, in general, I'm cautious on companies that are trying. Everybody is trying to do everything, because by definition, if there is a company that has a competitive advantage or it has a moat, then it's difficult to do everything. Right? If you're saying a company can do everything, then is there really a moat in that industry if every company can do everything? So, look, what I would just say, and again, not getting into any company, any industry, is that, it's very difficult for a company to be good at multiple sectors, because you should, I try to look at companies that stick to their competitive advantage and invest behind that, rather than at companies that are trying to do everything.
Okay, just one last brief comment, Anish. Are there any sectors where you're significantly overweight relative to the sector benchmarks?
So we are overweight insurance, we are overweight cement, we are overweight industrial and capital goods. And that's been our view, that the cycle was strong, but progressively, as these sectors continue to do well, we've also been bringing down our overweights, right? As I was saying, if you like something at 100, you like it less at 200. So that's been the approach. We were confident that the economic cycle was strong, and we were overweight the domestic cyclical sectors. But gradually, we are reducing our overweights in some of these sectors.
Okay, thanks
and
a lot.
And the portfolios are published, so what I'm telling you is evident.
Of course. Yes. Thanks a lot for that. Appreciate your time here on CNBC-TV18. Let's move on now and talk about Sona BLW, which is the next management on the show. The company reported a very strong growth in revenues led by the battery electric vehicle segment, which has been a rage globally. In fact, the share of sales to battery EVs in revenues hit a new high of 33%. Vivek Vikram Singh, the MD and Group CEO at Sona Comstar, joins us now to talk about that. Mr. Singh, good morning and thanks a lot for joining in. This whole segment, right, the BEV segment has seen a very strong growth. It's seen a 53% top-line growth year-on-year in this quarter. But tell us, is this a sustainable performance? I mean, is this something that you can expect through the course of FY25?
Good morning. I think you ask me this question every time I come here. We've sustained above 25% CAGR for the last 25 years. So it shouldn't change much. Of course, there are hiccups in some quarters, in some years, but over the medium to long term, we will have a strong growth rate.
Mr. Singh, good morning. Prashant here. I was reading a report and I like what how it started with outlook cautious for the industry growth, but positive for the company.
I know, Prashant.
That's right. And that's I mean, of course, that's new programs, products, customers, right? So tell us a little bit. I mean, how is the interplay between how cautious is the industry? I mean, I think you've also characterizing it as such, both in EU and I think in the US as well, and your own prospects.
So, Prashant, I became CEO July 2019. I have never seen a good industry cycle in our industry. It's always been something bad. So basically what we've started to do is you budget for zero growth in the industry, and whatever you do has to be from your own efforts, which means you increase market share in products you already have, you introduce new products, you enter new markets. That's basically been our strength. Market for automotive in general has not been good for the last 5 years. That is a fact. It has been one thing after the other. I think in 2018, 96 million light vehicles were sold in the world. We have not crossed 90 for a while now. So it is a tough business to be in. You get better by doing the right things, making today better every day. And it is challenging, but it is also an opportunity for people like us who are truly different. We've introduced a lot of new products over the last 4 or 5 years, almost 10. That's how you get there. So, industry outlook continues to be challenging, and we continue to do well. That's the theme.
If you can give us some numbers, your share of sales to battery EVs hit a new high of 33% this time. I want to understand that how much higher do you think it can go? And with the share going up, does this mean that you can take your margins higher as well? I mean, you've done 28%. Is there scope to improve it further?
Yeah, so it will go higher. If you look at our order book, 79% of that constitutes EV. So it will go higher. Our near-term target for, I think, FY26 is 45%. Over the long term, I mean, let's say just 2030, it will be 65% plus. The future is EV, and that's where it's heading. The margin bit, Sonia, we don't have a desire to increase margins much further. The job of our management team is to ensure we have a good balance between growth, margin, and returns. When you focus on any one of these metrics, you tend to lose out on the other two. So our range always has been 25 to 27% is the range we like to be in EBITDA. We are slightly above that. Because of that, we've increased our R&D expenditure quite a bit this year. We will be trying some more new innovative things, some more risk-taking so that we can make tomorrow even better. So that's our approach. I don't think we're looking to increase margins more.
Okay, all right. Hi, Vivek. Good morning and good to see you. When, the other factors, you have approved raising some equity, I think more than 2,000 crores approximately. And there's a possibility you're looking at inorganic growth. Could you give us some timelines, the size of the potential acquisition, which geography are you looking at currently? Some brief details on that front.
Sure. So, yes, we are looking to raise equity. We have an enabling resolution, actually. We may raise equity if we need to. We are looking at quite a few opportunities, and they are all over the world. It's not one. We don't know which one will happen, which one will not, because, in a deal scenario, you either get it done or you don't. It's a binary situation, so probability doesn't matter. We have said, basically what we did is we took all the organic growth efforts, the capex required for them. We're looking at some more greenfield new product stuff. We're looking at some inorganic. All of that, what's the cash flow required if we had to do everything minus what we are generating and what we already have in our bank account? There is an amount. And when we applied the equity to debt ratio we want to, we will raise some debt. This is the number that we came to, but this is the maximum number. So the resolution is an enabling resolution that allows us to raise up to 2,400 crore. We will see where it goes, which opportunities progress more. It's everywhere, but the only thing I can assure you is they're all within our vision. We are a mobility technology company. We are not going to do everything everywhere all at once. We are going to stick to what we know well, and we will be in that space. We are not going to suddenly do random things. Our moat is in manufacturing of mobility technology products. That's where we're going to stay.
Absolutely. By the way, we are talking to another, almost mobility company, but from the technology side after you, KPIT. But that's in a bit. I have one question. So there is US elections later, right, Vikram? And so polls are putting Mr. Trump ahead. He's one of the first things he said. So one of the things he said, which he will do immediately, is do matching tariffs. So for example, if India's 100% import duties, he says, I'm just give an example. He'll match the tariffs, tariff by tariff, product by product. That's essentially what we don't know if it'll happen or not, but it's the stated objectives. And he loves tariffs, right? How are things for the sector? I mean, is the industry and the products, etc., you in at risk at all?
So not much. Our products don't have that much tariff. It's actually cars that have a lot of traffic. So if you're importing fully built vehicles, that's where the tariffs come. Auto parts, the tariffs not that high. But we have seen 4 years of Mr. Trump, or President Trump. I think there is a large gap in what is said and what is actually enacted in policy. And also, looking at how crazy American politics have got, let somebody win first. Then we'll see. We have North American presence ourselves. We have a plant in the US. We have 2 plants in Mexico. So our footprint is, I'd say, designed for these kind of turbulences that keep coming. Yeah. But tariffs, everybody loves them these days.
Yeah. No. Him more than anyone else. I think 30 years he's gone on about tariffs. So, and that Mexico bid also, he's addressed that. He said, well, this indirect routing of stuff into the US, he's got an eye up. So we'll see, right? As you said, let someone win first, given the state of politics there. It's a pleasure, Vikram. Great having you with us. Appreciate your time here on CNBC TV18. Thank you very much. And fantastic job there, as always. KPIT Technologies is the next company that we are speaking with. And it reported a good set of first quarter numbers. We have seen steady deal wins in the first quarter, but US business is under pressure. And sort of coming straight off after speaking with, Sona, Mr. Sachin Tikekar is President and Joint MD at KPIT Tech. He's with us. Sachin, great to have you with us here. Good morning, Prashant this side. You're also highlighting that there is certain pressures in the mobility segment on demand and profitability fronts. Is the pressure only in the US? Because Europe and Asia have done well for you. Just characterize the demand environment for you.
All right. Good morning, and thanks for having me. Just across, you've seen the growth has been robust, and we've had it's been 16 consecutive quarters of growth for KPIT, profitable growth. The growth is driven by Asia, as you can see, and we think that Asia will lead the growth in next few years to come, and followed closely by Europe. As far as the US is concerned, there have been 3 or 4 things that we are dealing with. One is some of the US-based OEMs have been acquired by some of the others, a couple of car makers, one of the truck makers, and that business for us has shifted from US to another geography. That's point number 1. Point number 2 is there are only a handful of pass car OEMs in the US that we can work with, and that's been our primary growth driver over the last few years. And there are a whole bunch of them on the what you call new mobility players on the West Coast. They're not quite part of our T25, the core accounts. So we sort of work with them, but there are no deep relationships with them. So these are some of the things that we have dealt with over the last year or 2, and that's why you've seen the growth is a little bit less in US as compared to the other geographies. Having said that, we think that the growth will come back in the US in the next year or 2. starting this year, actually, in the second half of this year. There are two reasons for that. One is we see more and more global OEMs investing in US because US somewhat is protected from the competition from the Chinese OEMs with 100% tariffs on the Chinese OEMs. So we believe that the Koreans, the Japanese, and the Europeans will double down on US because it's sort of a cocoon for them, and that sort of gives us an opportunity to work with them in the US. That's point number one. Point number two, we've been looking at off-highway as an adjacency for the last several months, and we've started to make investments in off-highway. And there are 3 or 4 big off-highway OEMs who are based out of US. As we build up the off-highway segment, we believe that we'll see a little more growth coming from the US. So overall, we hope to have a little more balanced growth as we get into the second half of this financial year.
Okay, all right. Hi, Sachin. Yeah. Hi, Sachin. First of all, good morning and thanks a lot for joining in. And congratulations. On a quarter-to-quarter basis, you'll keep surprising the street, valuations aside, but the delivery has been rather good. Let's focus on two markets. One is the US market, which has been growing in low single digits, and there is a bit of a worry. Even last night, you had Tesla's vehicle sales numbers were lower. So could you tell us, from this $44 to $47 million per quarter, how do you see it shaping up? By when do you think you can go closer to around the $50 million per quarter for the US markets? And Asia has been growing very, very well. Which markets do you cater to in Asia? Because the revenues there have doubled in the last 5 quarters.
Absolutely. Let me take the questions one by one. Let's talk about the US. As I mentioned earlier on, we do hope, because more and more of our global OEMs who are investing more in the US, we think that our engagements with them will grow. That's one reason. Secondly is the off-highway part that will start to kick in the second half of the year. However, we'll see substantial growth coming in over the next 2 or 3 years because it does take time to build and sort of create leadership in a new adjacency like off-highway from passenger cars or trucks for that matter. So to answer your question, we think that the growth rate will increase in the US from the second half of this year. And we think that next year we're going to see a little more balanced growth as compared to what we'll see this year. And that's when we'll get close to the 50 million run rate that you actually talked about and more. As far as the Asia part is concerned, our primary, the biggest part of our business today comes from Japan. There are a couple of OEMs that we work with in Japan, and that's complemented by Korea and India. There is an added focus from KPIT side on China. So we do hope that China for China and China for the globe will start to kick in for KPIT towards the end of this year. We also see that some of our OEMs who have been manufacturing vehicles in Thailand but have not done much work in terms of design and engineering in Thailand. So that's why we have not engaged with them in Thailand. But as a hedging, they may do more of design and engineering work in Thailand. Again, our global T25 OEMs who have presence in Thailand. So we think that Thailand can also become sort of an important country for us as we look at Asia holistically.
Just one final question then. What is the deal win run rate? I think in FY24 it was about $800 million. What is the run rate currently? And any big deals in the pipeline which are likely to convert over the next, say, 6 to 12 months?
Yes, we keep working. And the way we look at big, large, long-term engagements is slightly different. Over the last couple of years, we made some big announcements with 3 OEMs. However, not all the OEMs like to go out and make such announcements. That's point number one. And point number two, when you establish a long-term strategic partnership with an OEM, the business just flows in every month, every quarter, every year, and there is it's kind of hard to put it in one bucket and say it's kind of a large deal. But if you look at all of our diamond accounts and platinum accounts, the growth has been substantial in each one of them. So we do expect that our existing clients will continue to give us more than 85% of the growth in future. Having said that, to answer your question directly, there are a couple of OEMs in the US, there is one in Europe, and then there are two in Asia. There are about 5 of them who are our existing clients, but the relationship is not that of strategic partnership yet. We believe that at least 3 of them will be able to start something meaningful with them before the end of the year. So the pipeline that we have currently is enough for us to make sure that we stay well within the guidance that we have given in terms of our top line and bottom line, which is 18 to 22% year-on-year growth for this financial year. And as we get deeper into the year, we do hope that the pipeline continues to build up from where it is today. And, that will create growth opportunities for us as we get into the next financial year.
Mr. Tikekar, great conversation as always, and appreciate you joining us here on CNBC-TV18. I'm sure your investors are taking heed as you sort of continue to work to deepen some of those relationships into being more strategic for you all along. Well, I just want to quickly highlight what's happening with Axis Bank before we take a break. Axis is down 6%. It started down 3% in reaction to the numbers, but I think it's the single biggest drag on what the Bank Nifty is doing. And there you go. On your screen, it's maybe almost at the day's lowest point. That's a large cut for a Nifty name. And that explains why the Bank Nifty is down 1.5%, while the Nifty is down about half of it. So clear underperformance from the Nifty Bank, and large sort of blame, of course, lies on what Axis is doing right now. Some of the other result reactions like L&T, etc., also at the bottom of the screen. We'll take a break. We're back. We have Mr. Natarajan Srinivasan, Managing Director at CG Power and Industrial Solutions, to discuss the first quarter earnings. That's coming up in just a bit.
Welcome back. Well, let's get straight to CG Power Industrial Solutions. That's the next management on the show. The company reported better than expected operational performance, large part of the beat being driven by the power systems business. To discuss this and more, we have Mr. Natarajan Srinivasan, the MD of CG Power and Industrial Solutions. Hi, good morning, Mr. Natarajan. Thanks a lot for joining in. Well, could you tell us, has there been any impact for the elections on the order inflow in both your segments? That's the power systems as well as industrials. And more importantly, what's the outlook going ahead?
So order book as of 30th June 2024, it stands at about 7,054 crores. It's about roughly about 44% growth compared to last year, same quarter. Now, we have 4 businesses, if I may say so. One is motors and drives. The second is railways. Third is transformer. Fourth is switchgear, if for purpose of order book. Transformer and switchgear, we combine it as power systems. I think election has not impacted this because order flow inquiries both are very strong in this business. In the case of motors, I think there has been some impact on account of the elections. But there again, order inflow has been higher by 20% for motors compared to the last quarter on quarter. Compared to March, I think the order book inflows higher by about 20% for motor. Railways, I think there has been some slowdown in floating of tenders. I think those tenders will eventually get floated from now onwards. So therefore, that will be made up. Whatever is lost is going to be made up in the next quarter or beyond that.
Well, the performance of the power systems business has really been driving growth. So I wanted to understand from you, how sustainable is the top line margins for the power systems business? Have margins peaked, or is there scope for further upside?
So because of the demand environment and the huge order flow, generally pricing is better and therefore margins are better. But the current margins what we got in this quarter have been due to very favorable factors on every side. See, in this business, actually, every order will have a different margin because orders are got on a tender. Whenever you close an order on a tender, you will know what kind of margins you get. Exports, you will get a different margin. Here, actually, a favorable set of orders, and then with some export orders being executed. All these cumulatively contributed for one of the best quarters in terms of margin, where margins for this business will continue to be strong, continue to be in the teens, I would definitely say. But I'm not able to confirm whether this margin, whatever we get, can be sustained for the remaining quarters.
Mr. Natarajan, good to have you with us here. So the sequential decline in margins for the industrial business has been arrested. What does this indicate about pricing pressure? Where are margins headed from here?
So for the industrial business consists of two businesses. One is motors, other is railways. Here this quarter, actually, the railways business had a large volume, but lesser margin. Railways also, all orders are secured on tender. And then in some businesses, depending upon what others quote, and then, tenders will be finalized. And then if you are L2 or L3, you will have to match the L1 price. Therefore, while we have secured a lot of orders on higher volumes, margins have been lower because of lesser price. As you know, margin is a combination of sales price plus input cost. But because of the higher volumes that we have on railways, we are working on some cost initiatives. Going forward in the next 2 quarters, we will see margins improving for the railways segment. Then if the motors also come back from H2, which we feel from H2 onwards, motor business can make a comeback, overall margins can be better showing in both the businesses from the second quarter, second half from H2. I feel this can be better than what we had the H1.
Well, the Railway Minister, Mr. Ashwini Vaishnav, announced that a majority of the 2.5 lakh crore of budget allocation will be used for safety works. In light of the 55% stake acquired in CG Tronics, what is the opportunity available and the conversion expected as well?
So whatever you have said on the allocation in railways and subsequently what the minister has said, minister has specifically made a statement that, Kavach, that is train collision avoidance system, will get a large part of the outlay. And GG Tronics is one of the 4 companies in India right now which qualify for setting up Kavach systems across the railway stations and routes. And they will be participating in the tenders which are likely to get opened up in this in the next few months, both for loco tender as well as for the train tender. Though this company is a new entrant, they have got most of the trials have been gone through, etc. At least in the initial years, we expect to back 20% market share, 15 to 20%, minimum of 15, maximum of 20% market share in the overall tender. Assuming, supposing the tender values, let us say 6,000 crores, I think 1,500 to 2,000 crores worth of business is possible that can be backed by this company. And this is only a beginning. I think this safety and the entire aspect of embedded safety, signaling, then Kavach, etc., is going to be a prime importance for railways, and the business is there for the next several years, at least for the next 7 to 10 years. Therefore, we see opportunity, significant opportunity in domestic market, and Kavach also can be, once you are proven, once you execute some orders, there can be also export opportunities are there because it is one of the very cost-efficient models compared to whatever systems are available elsewhere in the European and other markets.
Is there an intention to acquire the entire state in the distant future? What are the synergies possible between both businesses and what additional product lines can be explored?
So I think, this company was founded by Manjunath, a technocrat. And then he and his son, who is also an engineer, they're very passionate and they built the company from a small level to this size. And they are actually, very passionate about running this business. And therefore, they will continue to be involved in the business. We will work with them. At this point of time, we have got 55% equity and they will continue to own 45% equity. While Kavach is actually solely the main business at this point of time. Anything to do with the embedded system, software, hardware, they've got 400 people working in this company. There will be a lot of opportunities in working together in our business, and then some of the new products that we will aim to jointly develop and do all that. So all those things will probably worked out in the next few months. But suffice to say that there is a huge amount of synergy for between GG Tronics and then CG's existing product portfolio, including the propulsion what we are developing, what we are almost completely developed, plus in certain other automations. A lot of opportunities are. Anything to do with power electronics, I think this company has got the capability to develop and execute. So whatever we were not considering earlier as for lack of in-house talent, now we will be able to bid and develop jointly with that.
Mr. Natarajan, when will new capacities come on board by this year, or by the end of this year and next year, and how quickly would you be able to scale this up? And incremental top line at peak utilization from these new facilities, if you could put a number to it, would be helpful.
So power, for example, in the power systems, the transformer capacity, we are doubling the capacity from 17,000 MVA to 35,000 MVA. This will be completed by Q4. And similarly, the distribution transformer capacity is also going almost doubling the capacity to 10,000 MVA. So because of the strong order book and strong inquiries, right from the moment these capacities are implemented, the minimum time that is required for ramping up as just as a capacity build-up. Otherwise, order is not a problem. Order is there. The quickly we are able to scale up the incremental facilities, we will be able to operate at a full level. So the transformer itself, because of the doubling, the current turnover can get doubled. About 1,600 to 1,800 crores is the increase in turnover that can happen from next financial year. Switchgear, actually, we are expanding capacities of various products, including setting up facilities for RMUs. So those facilities will get completed over a period of time. Some this year, some next year, and then probably by something in September 25. And here also, I think these are all products which have huge demand. And transformer and switchgear demands are generally complementary in nature. We don't expect to have any difficulty in servicing the higher capacity. If at all, we may have to think of putting up some more capacity to meet the demand. That is the scenario right now. Only in motors, the motor expansion, there also we are doubling our size. We are manufacturing about 90,000 to 95,000 motors. We can get doubled to about 200,000 motors per month if it is operating in terms of capacities. But how much we will be able to sell, how much we will be able to export, it depends on how quickly we are able to capture the export market. So there again, of course, we have set a time frame of about 4 years. So that capacity alone, it depends upon what kind of orders we are able to get outside India and how domestic demand quickly recovers and goes up.
Okay, sir, we need to ask you this before we let you go. The street is very excited about the OSAT business opportunity. Could you share with us a progress report on that?
So I think, we have recruited the senior team, and then we have started floating tenders for various civil works, machinery, equipment, etc., supply, etc. It will take some more time, maybe a couple of quarters to say meaningfully what is the progress we have made, etc. Otherwise, we are just at the beginning of doing all the project initiatives. But intention is to complete the first phase of the project to a large extent within 24 months. So maybe after a couple of quarters, we'll be able to share with you some more details.
Okay, thanks a lot for that. Let's slip into a quick break on that note. On the other side of the break, Manisha Gupta will put focus on the commodity markets. Metals have been extending their losses. So more on that in just a bit. Welcome back. Well, let's get going on some technical views. Nagaraj Shetty, the technical research analyst at HDFC Securities, is with us. Nagraj, hi, good morning and thanks for joining in. So this market is showing some signs of pressure, down about 120 points on the Nifty. Do you think it can get worse, and what is the strategy for the day?
Hi, good morning. Nifty has been a healthy downward correction from the high of around 24,850 odd levels. I'm not expecting any bigger decline, bigger sharp declines from here onwards. The gradual or a downward correction is likely to continue for the next 1 or 2 sessions. At the lower levels, 24,000 to 24,100 is going to act as a strong support. In fact, I'm expecting a decisive upside bounce from the lower levels, and whatever the decline from here onwards is going to be a buy and dips opportunity.
Okay, what about individual stocks? What are you looking at?
Yeah, I have 2 stocks. It's a mixed bag, one from a long side, one from a short side. Recently, we have seen insurance sectors booming from the lower levels, and SBI Life is the one where it has bounced back strongly from the lower levels. Currently, the chart pattern is looking very strong. We have seen formation of bullish engulfing at the lower levels and currently moving up around, trading around 1660 odd levels. One can look to buy at this point of time. The target would be around 1750, 1760, and one can place a stop loss at 1600. And the next one is sell side from a metal stock, metal sector. Metal has been in a downtrend over the last couple of weeks, and Tata Steel too has been a declining trend last 3-4 weeks. Currently, the stock price is moving towards the important support of 20-day EMA, which is 200-day EMA, in fact, which is currently around 150, 151. So currently trading around 157, 50, 158. One may look to short around these levels, and the short-term target would be around 150 odd levels on the lower side. One can place a stop loss around 162.
Okay, well.
All right. Thanks very much for those specific trades. Appreciate it as always here. You know, let's just look at the market for a quick bit. We are down 125 points. So this is, I mean, looking much better for the Nifty as compared to, of course, the Nifty Bank, where there is that problem of Axis Bank, which is still holding things up. Even broader markets. Broader markets had become almost advanced decline. Had become 1:1, one advancing to one declining, but is now shifted again. 900 up and about 1,500 down. So that is the advanced decline ratio. So keep an eye on these things as well. Commodities in focus. Metals, I think, are having a tough day as well. Manisha is here with the roundup. Manisha, morning.
Morning, and thank you for that, Prashant. As Nagraj was also pointing at, that we are at support levels, and further bearishness is what you can expect in many of these. So that's exactly what we are seeing as a trend as well. You know, April and May as months were amazing when it comes to metals. We saw prices decline in June, and July has been on a downward trajectory as well. And if you look at the last couple of weeks, it has been actually very sharp declines coming in. One is the US dollar has continued to strengthen, and that has been weighing on. And the other thing is, because the metal prices have not been able to make higher highs or hold on the higher side of the range, that has led to a lot of funds coming out with squaring their positions and profit taking as well, and that seems to be weighing onto the markets there. Apart from that, all the data that we have been reacting to has been on the weaker side. So whether it has been about the Chinese demand, which has been slowing, the economic data from China, whether it's the first quarter GDP numbers, home sales, retail data, investment, all of that came in on the weaker side. And the measures that China has also come out, markets are looking at that as very uneven and not structural. The US housing data, Japan factory activities numbers also have been weak. So not just China, but various other important economic data also have been on the weaker side, bringing the metal prices down from there. The inventories on LME and Shanghai have been building up, so much so that if you wanted the metals today, you would be getting it at discount vis-a-vis the next 3 months. So this is a backwardation that we're looking at in case of metal prices. So hiking inventories and the immediate physical demand on the lower side is the reason we are looking at most of these metal prices trading at a multi-month lows. Copper, which is also called the Dr. Copper, has seen a decline to a near 4-month lows. Gold is trading at a 2-week lows. Silver at 2.5-month lows. And steel rebar prices have been constantly declining. It's trading very close to its 7-year lows right now. And that trend basically continues for the other base metal prices also. So you have a 3 to a 5-month lows coming in for zinc, aluminum, lead and nickel as well. I also want to show you this via a table where you can see the kind of declines that we have seen on a week-on-week and a month-on-month basis as well. And that will tell you on what kind of declines we've seen for many of these metals. So copper has seen 5.5% of a cut coming in into the last week itself. And we have seen 7.5% of a decline onto this one in last 1 month. Similar is the case for steel, aluminum, 2 to 4% decline on week. And on a monthly basis, we are down by 5 to 9%. And that trend continues for zinc, nickel, lead. 3 to 6% of a cut coming in last 1 week. And in the last 1 month, as I said, we've turned absolutely negative for many of these metal prices. So whether it's zinc, which is down 10%, or 7% of a cut coming in for nickel and lead in the last 1 month. What the markets will watch out now is the US GDP number second quarter that comes in today. And tomorrow is the PCE price index, and that would give you further direction.
Okay, thanks a lot for that. Well, Tata Motors is the big stock on the move on the upside this morning. It's up almost about 3% if you're wondering why. Nomura has upgraded Tata Motors to a buy, and there's a big target price upgrade coming through. Target price on Tata Motors has been increased to 1,294. So that is a 29% upside to the current market price. Now, the key rationale is that they speak about how Tata Motors has transitioned from premium to luxury cars, and that is working very well for Jaguar Land Rover. The earnings growth can be much stronger because of a rise in the average selling prices and the margins. And they talk about how JLR's execution can lead to significant upsides. They've also raised the target prices and target multiples for the commercial vehicle business to 11 times EV EBITDA, and talk about how the demerger is a big positive for shareholders. So that is Tata Motors and why it's buzzing up almost 3.5%. Let's slip into a quick break. On the other side, Lata will get chatting with Shyam Srinivasan, the MD and CEO at Federal Bank, for their Q1 earnings. Stay tuned.
It's my absolute pleasure to welcome Shyam Srinivasan, who has just presented his last quarterly numbers as Managing Director and CEO of Federal Bank. Shyam is one of the few, maybe the only bank CEO who is not a founder but has still served 14 years at the helm of a bank, and that's the maximum Reserve Bank allows. In Shyam's last quarterly show, he has put up an impressive one. The bank has posted a profit beat in the June quarter and a steaming 20% advances growth. As of now in the result season, it's the highest in the banking sector. But what stood out for me also is the bank's cost of funds having fallen by 5 basis points at a time when there is cutthroat competition in the sector for bank deposits, term deposits. Well, that's a great way to bow out, Shyam. Many congratulations for a great 14-year innings.
Thank you so much, Lata. Thank you. It's certainly a good way to end, but I'm not yet ending. There's still 2 months.
Yeah, of course.
So,
the 2 months, 2 full months left. September 23, I understand, is when Manian takes over. Okay, well, I can remember the first numbers. It was 25,000 crores advances and 36,000 crore deposits, if I'm not mistaken. So it's a long way in 14 years. Well, first, let me get the news out of the way. How come your deposits cost has actually gone down? Do you think this is the best show you can do in deposits and the costs will start rising? How bad is the fight for deposits?
No, I think the fight for deposits is quite intense. That is an unarguable fact, and everybody is doing their best to ensure that the growth happens. We've always said we will fund before we lend, and we wanted to match credit and deposit growth. If you see for long periods, we've had somewhere, plus minus 1% credit ahead or deposits ahead. This quarter, thankfully, they matched up. This quarter also saw the most significant improvement that we were seeking to do is some comeback in our relatively low cost NR deposits. So that also played through. There was almost post-COVID for a couple of years, there was degrowth in NR deposits. Remittances were going up, but deposits were coming down. So we were gaining share in remittances, but they were not translating into deposits. I think that's, thankfully, that has been reversed. If you see our numbers this quarter, deposits from NR also started growing. So the blended outcome of trying to grow the deposits retail manner, as a consequence, we could shed some of our high-cost deposits. So this blend is where you saw the cost of deposit improve. And I don't believe that would materially come off. That will remain.
Okay. So NR deposits, what Shyam means is non-resident deposits. You must remember, this is a Thrissur headquartered bank down in Kerala and therefore has a large diaspora. Yes.
It's Alua, not Richu.
Alva. Sorry. Okay, Alva. I just think of the biggest city nearby. Shyam, therefore you're saying that the cost of deposits can continue to see pressure and it can go up for the industry, but y'all will be able to manage because of the higher NR deposits, your deposit cost will stay under control?
Yeah, in this range, Lata, these are hard to predict to the last decimal, but it's not going to be a runaway increase unless the whole industry sort of gravitates to pricing up, in which case it has to play through with higher cost of lending, which is probably not a great thing. But so you'll have to sort of keep this in watch. But I do believe the momentum we've created in our granular retail deposit growth, if you see for long quarters, but certainly the one that went by, our growth in customer deposits has increased. In fact, 90% of our incremental growth is customer deposits. We've debulked to some extent.
Oh, that's excellent. Advances growth is very good, over 20%. Your verticals have shifted now a little bit to corporate. Would you say that you will continue in that direction, or will you all... no, I mean, the bulk is still coming from retail, but there is a bit of a... Yeah, go ahead.
The mix, if you see that across corporate, commercial, within retail, the traditional conventional retail, and then gold and agri microfinance, we've just diversified it quite well. You slice it many ways, you don't see any pronounced jump up in any one. Most businesses have sequentially grown between 4 and 5%, except for businesses where we have such a small base, which are growing at a much higher clip, right? Because businesses like credit cards, microfinance, agri,
I'm asking you also because, I mean, I noticed that in some other banks as well, a little bit of a lean on corporate. Is it that retail has been juiced out a goodish bit and the capex cycle is starting? So will you start seeing corporate sector loan growth, kind of outpacing a bit on the margin?
Yes, it will. But for us, I maintain we're still sub 2% market share player in any category. So for us, we should be pursuing nothing less than 4-5% sequential growth for every business. So on a base of 200,000 crores of credit, growing roughly 10,000-12,000 crores a quarter should be our focus, and that's divided across all our businesses.
Okay. Well, let me ask the most pressing question, which all analysts will be watching out for, and of course spoke in the analyst call. What are the margin range? I mean, you've fallen just by 5 basis points compared to quarter ago. Year on year, you're absolutely stable. Will it be a 3.1 to 3.2 range, or will you be able to go to the upper end of, over 3.2?
No, we must be honest. This is unlikely to jump up into the mid 3.2 kind of range. We've guided this year somewhere in the 315 to 320, if you're lucky, a couple of basis points more. But as long as our credit quality holds, which, as you see, for long periods of time has held well, we should be able to deliver on many of our promises. So I think a focus not just is margin. The important and useful point to note is that the NII, which is the more direct measure from a revenue point of view, has grown in pace with credit growth. So we haven't compromised either quality or pricing capability. So I think that's an important measure to keep watching.
Okay, a common factor in all bank results, HDFC, Axis, yours, Bajaj Finance, has been higher slippages. Now, for banks, the first quarter tends to be, a quarter where agricultural slippages at least come out. Would you say it is just this one quarter, or do you think that the best of asset quality is behind us and we may start to see it inch up somewhat?
I don't know about the other banks. You look at our numbers, 417 was the slippage this quarter. Last year, first quarter was 495. Q4...
No, I mean quarter on quarter, it's up.
Sequentially, it may pick up because Q4 typically is the quarter which has the least slippages across the category. But we haven't seen any increase in slippage. In fact, sequentially, and if you see the average of last year, is about 400 and something. And it will be in that same space. And on a 20% higher denominator.
Okay, fair enough. What about ROA? I mean, there has been a significant improvement, and if I remember right, you once even said that that will be your goal. You're almost at 1.3. You had done even 1.4 a couple of quarters ago. What would be your task for Manian in terms of ROA?
And I think we've guided for 1.4 by FY26. I think we are quite close for that. And knowing Manian, he will set himself a much higher goal and take it to another level, but we'll leave that for the new leader to take it up. But I think we are on course for a 1.4 in FY26.
Okay. Well, I do hope I will be able to speak with you again, but I still want to ask you this. What was your toughest moment in this 14-year journey? Was it surmounting unions? I guess when you walked into the bank, people were still writing with pen and paper. Was it computerization and digitization? What was the biggest challenge?
No. We've always been good on digital. I think my toughest moments are answering people like you. Very difficult. It's never been running of the bank. It's answering the many stakeholders who have rightfully many questions, right? So often answering and delivering on that promise has been the tough one. But, I think on balance, we've done well. Certainly, we'll have a longer chat about closer to end of September. We'll chat.
Yes. Absolutely, absolutely. What would you, say in terms of year-end advances growth, your margins you gave me and ROA? What kind of growth? Do you see growth getting a little tepid because of this deposit fight?
It can, but we believe, we had originally said between 18 and 20, the worst case it will be 16 to 18. But I think that kind of growth is very possible.
18 to 20 is possible.
Yeah, that's what we are looking at. But, if things don't stay up as well as in the environment, we may calibrate it to 16 to 18. But I think it's very possible. Current run rate suggests that's on. Good momentum across all our businesses.
Okay.
And you must recall in some of our businesses, we had to slow down because of some regulatory requirements. Those can come back in the second half. So again, that can be a good fill-up.
Okay. And the biggest challenge would be deposits?
Yeah, if it is this kind of growth with the current deposit momentum, we should be okay. Deposit price, if the market gets tough, certainly we have to be more watchful. That could be the only lever that we have to continuously watch. I mean, the same things, I don't think it changes, right? For long periods of time, credit deposits and asset quality is all a banker should worry about. So,
yeah, absolutely. And your credit deposit is not something that would worry you or the investors or the Reserve Bank at this point in time. And I think 83, it's one of the lower sides compared to other banks. Shyam, many congratulations for a very good last quarter. And we will, of course, speak again to gauge this 14-year career and what challenges you're leaving on the table for KVS Manian. Thank you very much for joining us today. So, well, that's the word coming from a federal bank. A very good performance as far as loan growth is concerned and maintaining margins and asset quality in spite of that growth. 20% not easy in these times. And likewise on deposits, and actually a lower cost of deposits. We wrap up on Bazaar on that note. Chartbusters coming.